Hey traders, this is Cousin Vinny coming to you from theclosingprint.com on September the 28th, Sunday, with a look at the week ahead. Some of the things we'll be looking at this weekend are news last week, Bill Gross's departure from PIMCO and its effect on high yields, CalPERS exiting the hedge fund arena, a $2.8 trillion per year market, CalPERS being the California Public Employees Retirement System. David Zervos, which spoke about the bull market sending ominous new tones. Fed easing appears to be in sight. A lot of people are talking about the possibility of ending in October. The Yellen speech sounding warning bells, not trumpets, and the dollar raining on the Fed's parade. Yukarwitz also talked about presidential midterm election years and the weakness that we see during this time of year, which could play into the markets as well. Over the past 4 presidential midterm election years, we saw 8%, 16%, 20%, and 34% corrections. And lately the complacency has been kicking in. So those are some of the things that we'll be looking at this weekend. Starting off with the news that Bill Gross had left PIMCO to move over to Janus. He personally oversaw more money than any other investor on the planet. The thing about the chart, though, that we have to focus on is the ascending wedges that formed just prior to retesting the lower trend line before falling off dramatically. And we see that happening currently on the PIMCO High Yield Fund. Are we going to retest this descending trend line and turn over? That's yet to be seen, but it's something that we're watching along with HYT, PHK, and junk bonds, JNK. This is a chart of the S&P 500 with junk overlaid. You can see that we're close to an area that we lost once before back in late July, as well as HYG, corporate high yield, bouncing off of the support level currently. We saw some buyers on Friday. This is something that we should consider from a long-term perspective regarding the direction of our stock picks and the sectors that we invest in. In other words, we want to be where the money is flowing. Also in the news was CalPERS exiting hedge funds. With over 10,000 hedge funds, it was quite a shock last week to hear that CalPERS is getting out of the hedge fund arena. There's $2.8 trillion per year managed in that area of the markets. How does that affect us? Well, I think it has a big effect on what we should be looking at over the weeks ahead in terms of risk to your portfolios long term, and determining where that money is flowing has a very big impact on what we invest in short term as well as long term. Other news that we saw over at Business Insider was one of the biggest bulls for the past few years is David Zervos was talking about the 5-year bond yield, which we see here making new highs. He was talking about Yellen's speech this week sounding more like warning bells, not trumpets, and the dollar's strength raining on the Fed's parade. Now, he also mentioned the fact that many in this area of the market that the end of QE appears to be in sight. So what does all that mean to the markets? We're trying to sift through all the data and get an idea of how much we want to risk going into the weeks ahead. Something that Yukarwitz also pointed out was midterm election years. The past 4 have seen lows late summer, September, October. We need to be aware of the fact that that is a possibility going into October. Okay, so let's look at some indices charts. This is the comp we saw over the past couple of weeks. We thought this volume by price bar was going to be resistance. At this point it still remains to be same. We have the 50-period moving average, the green line here. Prices pushed down through and closed back above on Friday. We are anticipating a further bounce. How far is yet to be determined, possibly back up to this volume by price bar, just based on the fact stochastics is oversold. We had a distribution day, and we have the Indy XA50R, the number of stocks trading above their 50-period moving average, down at 48, and could see a further dip down before it gets into a buy zone, and all of these line up, but it's something that we are watching nonetheless. The Dow Industrials also saw a nice bounce on Friday after moving down and closing right at the 50-period moving average, as well as the lower Bollinger Band. We do see RSI trying to bounce and stochastics oversold and turning. So I would expect a further bounce on the industrials until we see price action. Otherwise, we have to watch what price is doing. The New York Stock Exchange Composite Index nearly got down to a 50% retracement level where we bounced on Friday. We were looking for this zone. This is Fibonacci's that we had drawn over the last couple of weeks, and we were looking at what would happen at 382 and 50%. So we see the percent decline that we've anticipated has played out, and now we're waiting to see what happens with regard to the 10 period and the 50 period rolling over and crossing last week. Note the 50 period is flat and looks like it wants to turn, and the high-low index is down below 50, which in the past you can see what happened when we dropped down below 50. NYSE, the New York Stock Exchange Summation Index, also hasn't given us a signal just yet. So now what we're watching is this divergence that a lot of people have pointed out over the past week playing out now. S&P finally caught up with the advanced decline, and we see that indicator rolling over. The Russell, we're watching this level right here where we've seen buyers in the past. Possibility of a retest of this ascending trend line. We also have the 50-200 cross up above that if we make it through that trend line, we could possibly test the 50-period moving average. But we are oversold and turning at present. MACD looks like it could turn as well as RSI down at the 30 range. So I'm thinking short-term bounce in the Russell, and what happens shortly thereafter going into October is yet to be seen. Here's a chart of the S&P 500 daily with Elder Impulse enabled. We're watching for a green candle or a green stick on Monday, Tuesday, with a major distribution day last week on Thursday. Obviously, we made it above the 90% level. These do come in twos, so there's a possibility of a lower low on the S&P, followed by spikes and a major accumulation day. We want to see a major accumulation day before we're out of the woods yet. Even spikes into the 50 and 60% range would be great, as you can see in the past where those bottoms have occurred. We have this trend line, if we extend it out, that extends out to the 1940 area, so we'll keep that on our radar as well. Tick cumulative, this is self-explanatory. When you have more buying than selling, you see a crossover to the upside, and when you see more selling than buying on the tick, which is a real-time sentiment during the day that we follow, you want to see continuous hitting the ask on the 5-minute tick during the day, which indicates that institutions are buying at the ask. So you'll see plus 1,000, plus 800, numerous ticks indicating that institutions are buying, not just what they're saying they're buying, but it's a real-time sentiment indicator that tells you to look for further upside. So that's one of the indicators that we'll be looking at predominantly going into the week. That tick is confirming what we are suspecting. Now, down below, we also have NYMO, which got down to minus 84, as well as the trend, which when you see these spike come towards each other in the reverse, that's a bullish indicator short term that we could see further continuation to the upside or a bullish bias. So we want to watch this area here for a green stick on the S&P 500 Elder Impulse for further indication that we could reverse and continue to move higher. So NYMO does look good, as well as trend presently. So we'll be watching the cumulative on the tick going into the week. The risk event indicator, we can see we popped right back above 90%. We want this ratio to get back down below 90%, further confirmation that we could see continuation to the upside. DBV, the currency harvest fund, this is a reflection of the carry trade. We've told you in the past, moves higher are bullish for equities and move lower are bearish for equities. We could see this area down here tested in the short term. If we see a bounce on Monday or Tuesday, that would be a good sign. You would need to see the US dollar weaken short term in order for that to occur. Looking at a chart of the US dollar, we can see it's very obvious that we continue to move higher. We pointed out that when the upper Bollinger Band and lower Bollinger Band are both headed in the same direction, that we could grind higher. However, we are making fresh new highs on a short-term basis. If we look at a longer-term basis for more relevance, by going out to the monthly chart, we see levels here extending these trend lines that we're breaking above. We have the 200 period on the monthly up here at 90. We see relative strength continuing, and we see full stochastics up in the overbought territory. So we could see some short-term weakness in the US dollar, which would be reflected in the DVV, the carry trade, where we could see a temporary bounce. But this is somewhat troublesome in the fact that the US dollar is viewed as safety. With the troubles in Ukraine continuing, there are variables out there that smart money may see that we do not see. So we have to be aware of the price action on the US dollar and how it affects stock prices. Obviously, the stronger the dollar, the fewer dollars it takes to buy a given asset. So that translates into the S&P 500 being lower, not higher. So keep that relationship in mind. Follow the DBV, and that'll give you a short-term indicator on which way you can expect the markets to move. With the dollar higher, you would expect gold to be weaker, which is exactly what has been happening. We see a bear flag forming currently. I would expect gold to move lower if the dollar continues to strengthen. If the dollar starts to taper off, you might find a trade in gold short term, maybe up to the 20 period moving average, perhaps up to the 50 period moving average. That's yet to be seen, but it's something to consider if you like to invest in gold or trade gold. The 10-year bond yield, we could see a retest here and a possibility of a move higher. Note MACD is turning to the upside. We had a crossover. We have long-term support resistance right here that we bounced off of, pointed out over the last 8 weeks, and we can continue to see a inflection point here. So watch what these moving averages are doing and price action on the 10-year yield. This is a chart of the 20-year Treasury bond fund on the weekly. Note the resistance level up here at 119. We have a nice bounce off the 20 period moving average, the midline of the Bollinger Bands. That is something we'll be watching very closely because we have 75% of our funds in our 401k are in bonds. Note the accumulation continues to move higher after a brief dip on that pullback off the upper Bollinger Band that Yukawa called several weeks ago. Again, this is Cousin Vinny coming to you from theclosingprint.com. I hope this helps. We'll talk to you soon. Take care.